Hello everyone, back again with another educational video. Now in today's video we're going to talk about why it's important to pay back your policy loans in your high cash value life insurance policy. Now a lot of times when you hear people talk about, especially using the policy for the concept of infinite banking, you'll hear people on social media explaining it, saying that you can borrow against your policy and you don't necessarily have to pay the loan back and they'll just subtract it from your death benefit. While that may be true, what a lot of people aren't talking about is actually the danger of having that practice where you could actually lapse your policy if you continue not to pay back your loan. So not many people are talking about that, but there is some dangers in having that practice. So I would advise you not to have a practice like that. You should actually have a practice of paying back your loan as soon as you can, and and then keep on putting money into the policy and keep on using it as you should. The only time I suggest doing that where you don't have to pay back your loan is in the retirement years, where you actually build up the policy so much, it has strong cash value and it's built up for so long that you can afford to not actually pay back anything until you die. They subtract it for your death benefit from your death benefit. So the best way for me to really show you how that could be a danger is actually to draw out a scenario and show you what's happening, when you don't pay back your policy loan. So let's do that. So let's take this example. Let's say in this particular example, you have 30,000 of cash value. Okay? And you're taking 25,000 loan. And the interest is 5%. 5% interest, and you have a death benefit of 500,000. Okay, so that's our scenario here. So you take out your loan. So now what you're going to see in your policy, now we talk about whenever we borrow against our policy, we're going to get credited. And not every company does this, so you do have to select a company that does this. You're going to get credited on your 30,000. So you take 25,000 from the policy, the insurance company loan you that money, and you're going to get credit interest on 30,000. Based on the company you're working with, they credit your interest as if your full principal was there. So, but when you go online and you check your policy, you're not going to see 30,000. So I want to make that very clear. You won't see 30,000. What you're going to see is you're going to see your cash value 5,000, because that's what you have available to use, right? 5,000. Then you're going to see your loan balance. Your loan balance is going to be 26,250, because the 25,000 that you took plus the 5%. So this is what you will see as your balance that you owe now. And your death benefit is going to be 473,750. So immediately you'll see that they're not waiting for you to die. You'll see immediately that balance, the amount you owe on the loan, is subtracted from your death benefit. So when you go online and you look at your policy and you see your statement and you see where you're at, this is what you're going to see. These are the numbers you're going to see. You're going to see that you have a loan balance of that, and you're going to see a death benefit reduced immediately. All right? So we're continuing that, right? Let me just erase this actually. The top section. So the second year now, in year 2, second year, your cash value is going to be 5,000 plus any interest that you might have gained. So 5,000 will be a cash value, and your loan balance is now going to be 27,000. That's going to be your new loan balance, because compounding interest works both ways, right? So it's not just in your favor where it compounds and you're getting interest on your new principal. It works the same way for loans. So now your new principal is this. So it's going to be 5% of this figure, not 5% of the original 25,000. Follow me? So it's now going to be, this is your new figure, because that 5% is now 13,1250. So that's why this is your new figure, and your death benefit is now going to be 472, 437.50. Okay? So the longer you don't pay your loan is the more it starts adding up, because your principal becomes higher, because once you don't pay, whatever your interest was plus the original loan balance becomes your new principal. So let's look at the third year, and after this I'm sure you'll get the point if it continues. So your cash value, okay, and your loan balance is going to be now 28,940,625, because the new 5% is 13,78125. So now your death benefit is further reduced, 471.5.375. So your death benefit is now further reduced. So you see the point. If it continues, then it's going to be compounding, and the more it continues, that's going to compound even more, just like it works in your favor on the end when you get more interest. As your money grow, and your interest is going to become higher, because it's now compounded. It's now a higher figure that you're getting that percentage on. It works the same way for a loan. As you continue to not pay, it's compounding, and that figure is going to get higher and higher, and 5% is going to be a much higher number. And as you can see, what's going to happen, two things that's going to happen to you here. One, you're in danger of your policy lapsing, because your death benefit keep getting reduced. So your death benefit keeps getting reduced, so your policy is in danger of lapsing. The other thing is that the whole point of you getting this is to build great cash value. And when you pull your cash value out and you don't replenish it, it doesn't grow as well, right? You have less cash value in there. So when you're credited, you're not going to be credited right. And because you're taking away money that was there to build your cash value more. So I hope that makes sense to you guys. I hope you understand the danger where if you have that practice, like I said, I would advise that you do not have a practice of not paying back your loan. It makes your policy don't work as efficient as it should be, and you can actually risk, depending on your situation, especially if it's in the earlier years that you're doing this, where it hasn't really built up like it should yet, you're risking lapsing your policy and making your policy just blow up. So make sure you don't do that. Only do that when you're in your retirement years and your policy is grown so much that you could actually not pay back your loan until you die. Hope it makes sense to you guys. Hope the information was valuable. Please like it if you think it was, and share it with a friend if you believe that this information could be useful for them. And hit the notification bell and the subscribe if you haven't already done so. I don't know why, but so hit the notification bell also, so that anytime I drop a video, you'll be notified. So until next time, I'll see you guys soon.